When you are 30 years old, having 90% of your portfolio in stocks makes sense. You have decades to recover from any crash. But as you approach retirement, the math changes completely. Financial planners call this the irreversible mistake. Keeping an aggressive portfolio into retirement, then experiencing a major crash while withdrawing money. Once those dollars are gone, there is no do-over button. You cannot go back to work at 68 and rebuild your savings. The time to reduce risk is before you need the money. Not during a crash, not after a crash. Before. Now let me give you some perspective on the other side of this argument. Not everyone believes a crash is coming. Some analysts point out that the economy remains strong. Unemployment is low. Corporate earnings are growing. The AI revolution could drive productivity gains that justify current valuations. JP Morgan's research notes that unlike the dot-com era, AI is actually monetizing. Companies are making real money from AI products and services. Data center utilization is running at 80%, compared to the massive overcapacity during the fiber optic glut of the 1990s. If the economy accelerates and inflation falls, the World Gold Council models show gold could actually decline 5 to 20%. There is no guarantee gold goes straight to $5,000. This is why I am not telling you to bet everything on gold. I am telling you to prepare for multiple scenarios. The upside scenario where stocks continue rising, and the downside scenario where they crash. Proper diversification protects you either way. But let me go deeper on some critical points because understanding the mechanics is what separates people who protect their wealth from people who lose it. Let me explain exactly how gold investments work, because there is a lot of confusion here. When people say invest in gold, there are actually 5 different ways to do this. Each has advantages and disadvantages. The first way is physical gold. This means actual gold coins or bars that you hold in your possession or store in a vault. The advantage is you have direct ownership. No counterparty risk. If the financial system collapses, you still have your gold. The disadvantage is storage and insurance costs. You also pay a premium over the spot price when you buy, and you receive less than spot when you sell. This premium can be 3 to 8%, depending on the product. The most common physical gold products are American Gold Eagles, Canadian Gold Maple Leafs, South African Krugerrands, and gold bars from recognized refiners. If you go this route, only buy from reputable dealers and verify authenticity. The second way is gold ETFs. Exchange-traded funds like GLD and IAU hold physical gold in vaults and issue shares that track the gold price. You can buy and sell these shares in your brokerage account, just like stocks. The advantage is liquidity and convenience. No storage hassles. Very low premiums. The disadvantage is you do not actually own the gold. You own shares in a trust that owns gold. There is counterparty risk with the custodian. For most investors, gold ETFs are the simplest option. The expense ratios are low, typically around 0.25 to 0.40% per year. You can buy and sell instantly during market hours. The third way is gold mining stocks. Companies like Newmont, Barrick Gold, and Agnico Eagle mine gold from the earth. Their stock prices tend to rise faster than gold during bull markets because of operating leverage. If it costs a company $1,000 to mine an ounce of gold, and gold rises from $2,000 to $3,000, their profit per ounce doubles from $1,000 to $2,000. The stock might triple even though gold only rose 50%. The disadvantage is mining stocks carry company-specific risks. Management might make bad decisions. Mines might flood or face regulatory problems. Miners underperformed gold for most of the 2010s despite gold prices rising. The fourth way is gold futures and options. These are derivative contracts that give you leveraged exposure to gold prices. You can control 100 ounces of gold with a small margin deposit. If gold moves in your favor, you make huge returns. If it moves against you, you can lose more than your initial investment. For most individual investors, I do not recommend gold futures. The leverage cuts both ways. These instruments are designed for professional traders and hedgers. The fifth way is a gold IRA. This is a self-directed individual retirement account that holds physical gold instead of paper assets. The gold is stored in an approved depository. You get the tax advantages of an IRA combined with physical gold ownership. The disadvantage is higher fees. Custodians charge annual storage and administration fees that can total $100 to $200 per year or more. You also cannot take physical possession of the gold until you take a distribution. If your goal is diversification within a retirement account, a gold ETF in your existing IRA is usually simpler and cheaper than setting up a separate gold IRA. Now let me address another important topic: the difference between gold and silver. You may have noticed that silver is also surging. Silver gained approximately 140 to 150% in 2025. That is more than double gold's return. So should you buy silver instead? Silver has two characteristics that make it different from gold. First, silver is both a monetary metal and an industrial metal. About 50% of silver demand comes from industrial uses like electronics, solar panels, and medical devices. This means silver's price is more sensitive to economic growth. In a recession, industrial demand drops, which can offset safe haven buying. Second, silver is more volatile than gold. It swings up faster in bull markets and down faster in bear markets. If you are looking for stability, gold is better. If you are looking for maximum upside and can stomach the swings, silver has historically outperformed during precious metals bull markets. Many investors hold both. A common ratio is 70% gold and 30% silver within their precious metals allocation. Let me also explain something about gold that confuses many people. Gold does not produce income. Unlike stocks which pay dividends or bonds which pay interest, or real estate which generates rent, gold just sits there. You are betting purely on price appreciation. This is why some famous investors, including Warren Buffett, have criticized gold as an investment. Buffett has said that gold is dug out of the ground, melted into bars, and then buried again in vaults while people pay guards to watch it. It has no practical utility. This criticism has merit. Over very long periods, stocks have outperformed gold. From 1971 to 2024, traditional stocks averaged 10.7% annual returns, while gold averaged 7.9%. But this criticism misses the point of gold ownership. You do not buy gold expecting it to outperform stocks over 30 years. You buy gold as insurance. You buy it to protect wealth during the periods when stocks crash. And as I showed you earlier, gold has done exactly that during every major crisis of the past 50 years. Nobody complains that their fire insurance did not make money while their house did not burn down. That is not what insurance is for. Gold serves a similar function in your portfolio. Let me now talk about timing. People often ask whether they should wait for gold prices to pull back before buying. Here is my honest answer. Nobody can time the market consistently. Not me. Not the biggest hedge fund managers in the world. If you wait for a pullback that never comes, you miss the entire move higher. The better approach is dollar cost averaging. Instead of trying to pick the perfect entry point, invest a fixed amount at regular intervals. Maybe you invest $1,000 in gold every month. When prices are high, you buy fewer ounces. When prices are low, you buy more ounces. Over time, your average cost smooths out. This removes the emotional decision-making that causes most investors to buy high and sell low. Now let me circle back to the Federal Reserve situation, because this is extraordinary and directly relevant to everything I have discussed. The criminal investigation into Jerome Powell is unprecedented in the 112-year history of the Federal Reserve. No Fed chair has ever faced criminal charges while in office. Powell's term does not end until May, but there is now speculation that he could be replaced earlier. Why does this matter for gold and retirement accounts? The Federal Reserve is supposed to be independent from political pressure. This independence allows the Fed to make tough decisions, like raising interest rates to fight inflation, even when those decisions are unpopular with politicians. If that independence is compromised, the historical precedent suggests the Fed would be pressured to print more money and keep rates artificially low. This is inflationary, and inflation is the number one driver of gold prices over the long term. Countries that have politicized their central banks, like Argentina and Turkey, have experienced currency collapses and surging gold prices in local currency terms. If the United States goes down this path, the implications for gold are extremely bullish. For retirement accounts, the implications are more mixed. Very loose monetary policy could inflate stock prices in the short term. But the eventual bill always comes due through higher inflation, which erodes purchasing power, or through a financial crisis when the bubble eventually pops. The current situation adds another layer of uncertainty. And uncertainty is gold's best friend. Let me address one more question I often receive. What about Bitcoin? Is it not digital gold? Bitcoin shares some characteristics with gold. It has a limited supply. It cannot be printed by governments. It has become a speculative asset during times of monetary uncertainty. But there are crucial differences. Gold has a 5,000-year track record as a store of value. Bitcoin has existed for 16 years. Gold is universally recognized and accepted. Bitcoin is still not widely adopted for transactions. Gold has proven itself during multiple financial crises. Bitcoin has never existed during a true global financial crisis until the COVID crash of 2020, where it initially fell 50% before recovering. In a 2025 Bank of America survey, 58% of fund managers said gold would be the best performer during a trade war, compared to just 3% for Bitcoin. I am not saying Bitcoin is a bad investment. I am saying it has not proven itself as a reliable safe haven the way gold has. For retirement planning, where reliability matters most, gold has the stronger track record. Let me give you a realistic example to tie everything together. Imagine a 62-year-old named Maria. She has saved $800,000 in her 401k. She plans to retire at 65. Her current allocation is 70% stocks, 25% bonds, and 5% cash. If the next 3 years are normal with average stock returns of 7 to 10%, Maria retires with roughly $1 million. Her plan works fine, but what if the market crashes in 2026? What if stocks drop 50% over 18 months? Maria's 70% stock allocation, roughly $560,000, would fall to $280,000. Her total portfolio would drop from $800,000 to around $500,000. She would have lost $300,000 just as she approaches retirement. Now imagine Maria had repositioned her portfolio in late 2025. She reduced stocks to 50%. She added 10% to gold. She increased bonds to 30%. She kept 10% in cash and short-term bonds as a liquidity bucket. In the same crash, her losses would be dramatically smaller. Her stock portion would still fall, but she has less exposed. Her gold would likely rise, partially offsetting the stock losses. Her bonds might hold value or rise as interest rates fall during the crisis. Her cash bucket remains untouched. Maria's portfolio might only drop to $650,000 instead of $500,000. And she would not need to sell any stocks at depressed prices because she has 3 years of expenses in her liquidity bucket. The difference between these two Marias is preparation. Same age, same savings, completely different outcomes based on their portfolio construction. Let me also briefly discuss what happens after a crash. Markets have historically recovered from every downturn in history. The question is how long recovery takes. The average bear market since World War II lasted 11 months with 35% declines, followed by a 2-year recovery to previous highs. But severe crashes take longer. After the 1929 crash, the market did not return to its previous peak for 25 years. After the 2000 tech crash, recovery took over 6 years. If you're in your 30s or 40s, time is on your side. You can weather any crash and eventually benefit from the recovery. If you're in your 60s, you may not have that luxury. 6 years without your portfolio recovering could mean running out of money or dramatically reducing your lifestyle. This is why the advice is different for different age groups. Younger investors can afford to stay aggressive. Older investors approaching retirement need to think defensively. Here is my final framework for thinking about this. Ask yourself 2 questions. First, what happens to my retirement if stocks keep going up for the next decade? If you own stocks, you benefit. If you reduced stocks for gold and bonds, you might underperform. You leave some money on the table, but you still grow your wealth. Second, what happens to my retirement if stocks crash 50% in the next 2 years? If you own stocks without protection, you are devastated. If you diversified into gold, bonds, and cash, you preserve most of your wealth and can actually buy stocks at bargain prices. The downside of being cautious is underperformance during good times. The downside of being aggressive is financial destruction during bad times. For most people approaching retirement, the math favors caution. You do not need maximum returns. You need enough returns with protection against catastrophe. Gold is not a prediction that the world is ending. Gold is insurance that your wealth survives, regardless of what happens. Combined with proper diversification and a disciplined withdrawal strategy, it gives you the best chance of a secure retirement. The forces I described today, central bank buying, geopolitical chaos, inflation pressures, interest rate expectations, and investment demand, these are not temporary. They represent a structural shift in the global financial system. Understanding this shift and positioning accordingly could be the most important financial decision you make this decade. Thank you for staying with me through this analysis. If you found this valuable, please like and subscribe. Share this with anyone you know who is approaching retirement. The information could genuinely help them protect their financial future. Take care, and I will see you in the next video. 5 days ago, something happened that sent gold prices to their highest level in human history. Federal prosecutors opened a criminal investigation into Jerome Powell, the chairman of the Federal Reserve. Gold hit a record above $14,600 per ounce. Let that sink in. The most powerful central banker in the world is now facing potential criminal charges. Powell himself called the investigation a pretext stemming from the Trump administration's frustration with interest rate decisions. And as this news broke, investors rushed to gold so fast that prices jumped 2% in a single day. Now here is the part that should concern you. While gold is exploding higher, nearly $46 trillion sits in American retirement accounts. Most of that money is tied directly to the stock market. And the same forces pushing gold higher are the exact forces that could devastate those retirement accounts. Today, I am going to show you exactly why gold could reach $5,000 or even $6,000 per ounce. I will explain the mechanics of why retirement accounts face serious danger. And most importantly, I will give you specific, actionable steps to protect yourself. Stay until the end because I will reveal the single biggest mistake retirees make during market crashes and how to avoid it. Let us start with what is actually happening right now. Gold just finished its best year since 1979. In 2025, gold prices rose approximately 65%. The metal began the year near $2,600 per ounce and climbed to over $4,300 by year-end, setting more than 50 all-time highs along the way. Think about that number, 65% in 12 months. The S&P 500, by comparison, returned around 17%. Gold crushed stocks by nearly 4-1. But here is what most people miss. This is not a random spike. This is a structural shift in how the global financial system operates. And understanding this shift is crucial for protecting your retirement. There are 5 major forces driving gold higher right now. The first force is central bank buying. Central banks purchased approximately 750 to 900 tons of gold in 2025. This is not normal. Before 2022, central banks bought around 400 to 500 tons per year on average. Now they are buying nearly double that amount. Why? Because countries are losing trust in the US dollar. When the United States froze Russian assets in 2022, it sent a clear message to every nation on earth. Your dollar reserves can be seized if you displease America. So countries like China, Poland, Kazakhstan, and Brazil are converting their dollars into gold. Gold cannot be frozen. Gold cannot be sanctioned. Gold cannot be deleted with a keystroke. This is called de-dollarization, and it represents the most significant shift in the global monetary system since World War II. The second force is geopolitical instability. Right now we have conflicts in Ukraine and the Middle East. The United States just conducted military operations in Venezuela that led to the capture of President Nicolas Maduro. There are rising tensions with Iran, and now we have unprecedented political uncertainty at the Federal Reserve itself. When uncertainty rises, investors flee to safety, and for thousands of years, the ultimate safe haven has been gold. As one analyst put it, all roads are leading to gold and silver. The third force is inflation. Despite what official numbers tell you, prices for everyday goods remain elevated. Housing costs are still near all-time highs. Food prices have not returned to pre-pandemic levels. Healthcare costs keep rising. When money loses purchasing power, gold historically preserves wealth. Here is a simple way to understand this. In 1971, 1 ounce of gold cost $35. Today that same ounce costs over $4,600. But that ounce of gold still buys roughly the same amount of goods and services as it did in 1971. The gold did not change. The dollar collapsed in value. The fourth force is interest rate expectations. When interest rates fall, gold becomes more attractive. Why? Because gold does not pay interest. When you can earn 5% in a savings account, there is an opportunity cost to holding gold. But when rates are falling, that opportunity cost shrinks. Markets currently expect the Federal Reserve to cut rates later this year. HSBC predicts gold could reach $5,000 per ounce in the first half of 2026, and if the Powell investigation leads to a more rate-cut-friendly Fed chair, that timeline could accelerate. The fifth force is investment demand. Global gold ETFs saw $77 billion in inflows during 2025, adding over 700 tons to holdings. This is money from pension funds, hedge funds, and individual investors all piling into gold. Now combine all five forces: central banks buying, geopolitical chaos, persistent inflation, falling interest rates, and surging investment demand. When you stack these factors together, you understand why major banks are predicting gold could reach $5,000 or higher. JP Morgan forecasts gold averaging 5,055 slon per ounce by the fourth quarter of 2026. Goldman Sachs sees $4,900. NZ predicts gold above $5,000 in the first half of this year, and in a severe economic downturn, the World Gold Council models show gold could rise 15 to 30% from current levels. That would put gold between $5,300 and $6,000 per ounce. Now here is where this gets critical for your retirement. The same forces pushing gold higher are creating enormous risk for retirement accounts. Let me explain exactly how this works. US retirement assets total nearly $46 trillion. This includes 401ks, IRAs, and pension funds. For most Americans, these accounts represent their entire financial future. Here is the problem. The average person in their 50s has 36 to 43% of their retirement account invested in US stocks. For those in their 60s, the percentage is similar. Even target date funds, which are supposed to automatically reduce risk as you age, often hold 90% in risky assets like stocks and long-term bonds. This means millions of people nearing retirement have their life savings directly exposed to a potential stock market crash. And the warning signs are flashing red. Institutional investor surveys show 80% of professional money managers expect market declines in 2026. 49% see odds of a significant correction. 20% think a deeper crash is possible. The top concerns: stretched valuations. The S&P 500 is trading near 6,140 as I record this. That is expensive by historical standards. There is also massive concentration risk. The so-called Magnificent Seven tech stocks now make up roughly one-third of the entire S&P 500. If those stocks fall, they drag everything down with them. Then there are the AI bubble concerns. Many financial commentators compare today's AI frenzy to the dot-com bubble of 1999-2000. The dot-com crash saw the Nasdaq lose nearly 80% from peak to trough. Many investors lost their entire retirement savings. Let me show you what happens when crashes hit retirement accounts. In the 2008 financial crisis, the S&P 500 dropped 57%. Target date funds designed for 2010 retirees lost 30% or more of their value. Trillions of dollars in retirement wealth evaporated. Many people in their late 50s and early 60s had to delay retirement by years. Some never recovered. This brings me to the most dangerous concept in retirement planning. It is called sequence of returns risk. Here is how it works. Imagine you retire with $1 million. You plan to withdraw $45,000 per year, adjusted for inflation. In a normal market, this should work fine. But what if the stock market crashes in your first year of retirement? A study from US Bank Wealth Management examined two investors with identical average returns over their retirement. The only difference was when those returns occurred. The investor who experienced losses early in retirement ran out of money after 25 years. The investor who experienced gains early had money left over. Same average returns, completely different outcomes. The timing of returns matters as much as the returns themselves. This is why retirees are so vulnerable. When you are working and contributing to your 401k, market crashes actually help you. You buy more shares at lower prices. But once you retire and start withdrawing money, crashes are devastating. You are forced to sell shares at the worst possible time. There are 75 million baby boomers currently in what financial planners call the retirement risk zone. This is the period 5 years before and 5 years after retirement. If a major crash hits during this window, the damage can be permanent. Now, I promise to show you why gold performs differently during these crises. Let me give you the numbers. During the 2008 global financial crisis, the S&P 500 lost 37%. Gold gained about 5 to 8%. While stocks were collapsing, gold was rising. During the dot-com crash from 2000 to 2002, the S&P 500 lost 49%. Gold rose 25%. During the COVID crash of 2020, stocks dropped 34%. Gold dropped initially but ended the year up 25%. In 8 major crises since 2000, gold averaged positive 11% returns, while the S&P 500 averaged negative 22%. This is what we call inverse correlation. When stocks go down, gold tends to go up. This makes gold an effective hedge against market crashes. But here is something crucial you need to understand. Gold is not a perfect hedge. It does not always go up when stocks go down. During the early days of the 2008 crisis, gold actually fell 25% as investors sold everything for cash. It then recovered and rose to new highs. Recent academic research published in the Global Finance Journal found that gold's safe haven effect has weakened somewhat since 2005. In some recent crises, gold's correlation with stocks has turned positive, meaning they moved in the same direction. This is important context. Gold is not guaranteed protection, but the historical evidence still strongly supports its role as a portfolio diversifier, especially during severe economic stress. Now let me explain exactly how these two trends could happen simultaneously. How gold could explode while retirement accounts collapse. The scenario works like this. The economy enters a slowdown. Maybe tariffs reduce global trade. Maybe the AI bubble bursts. Maybe inflation forces consumers to cut spending. Whatever the trigger, corporate earnings start falling. When earnings fall, stock prices fall. A market that is already expensive by historical standards could drop 40 to 60% in a severe recession. This is not a prediction. This is within the range of historical bear markets. At the same time, the economic weakness would force the Federal Reserve to cut interest rates aggressively. Lower rates make gold more attractive. Investors fleeing stocks would pile into safe haven assets. Central banks would accelerate their gold purchases as the crisis validates their de-dollarization strategy. The result? Gold could rise 15 to 30%, while stocks fall 40 to 60%. For retirees, this divergence is catastrophic if they are not prepared. Their stock-heavy portfolios would be devastated. Meanwhile, anyone holding gold would preserve their wealth. This is not some far-fetched doom scenario. This is exactly what happened during the stagflationary 1970s. It is what happened during the 2002 tech crash. It is what happened during the 2008 financial crisis. The pattern repeats. So what should you actually do? Let me give you specific, actionable steps. First, assess your current allocation. Log into your 401k and IRA accounts today. Calculate exactly what percentage you have in stocks versus bonds versus other assets. If you are within 10 years of retirement and have more than 60% in stocks, you may be taking too much risk. Second, understand your target date fund. If you own one, do not assume it is properly diversified. Many target date funds remain 90% in risky assets, even for investors near retirement. Read the prospectus. Know what you own. Third, consider adding gold to your portfolio. There are several ways to do this. You can buy physical gold coins or bars. You can invest in gold ETFs like GLD or IAU. Some 401k plans now offer gold as an option. You can also open a self-directed gold IRA. Most financial advisors suggest a 5 to 10% allocation to gold for diversification purposes. This is not about betting your entire retirement on gold. It is about having insurance if everything else goes wrong. Fourth, implement the bucket strategy. This is one of the most effective ways to protect against sequence of returns risk. Here is how it works. You divide your retirement savings into 3 buckets. Bucket 1 is your liquidity bucket. This holds 1 to 2 years of living expenses in cash and short-term bonds. This money is completely safe from market fluctuations. When markets crash, you draw from this bucket instead of selling stocks at a loss. Bucket 2 is your intermediate bucket. This holds 3 to 7 years of expenses in bonds and conservative investments. This money generates modest returns with limited risk. Bucket 3 is your growth bucket. This holds your long-term money in stocks and other growth assets. Because you will not need this money for 7 or more years, you can ride out any market crash and wait for recovery. This approach prevents the irreversible mistake of selling stocks during a crash fifth. Build an emergency fund outside your retirement accounts. Ideally, you want 3 to 6 months of expenses in a high-yield savings account. This prevents you from raiding your 401k during emergencies, which triggers taxes and penalties. Sixth, avoid panic selling. This is the single biggest mistake investors make during crashes. Research shows that investors who sold during the March 2020 COVID crash missed out on a massive bull market that pushed stocks to record highs just 8 months later. When markets drop, your instinct screams to sell everything. Do not listen to that instinct. If you have properly diversified and built your liquidity bucket, you do not need to sell at the worst possible time. Let me also address something I mentioned earlier. The biggest mistake retirees make. It is waiting too long to reduce risk.